Momentum is probably one of the most unused and unappreciated factors out there, which is actually kind of funny because it's one of my favorite factors. But the idea behind momentum is actually pretty easy. Buy what has been going up. Buy the winners. I made a video a couple of weeks ago talking about how I invest, and in there I talked about why momentum has worked almost better than any factor, at least historically. If you want to hear my thoughts about why I think it works, make sure you check out that video. In general, I tend to think of momentum as the underreaction to good news, and in my opinion, this is why I think momentum is primarily a behavioral factor. But how does one take advantage of these behavioral biases that exist in the market that allow for momentum to work in order to build a robust momentum portfolio? In this video, I want to go over potentially the first question one must ask when building a momentum portfolio. What look-back period should I use? In other words, where does momentum actually lie? So again, momentum means buying the winners. Buy things that have gone up. The problem is that most things have gone up at some point or another. You wouldn't call a stock that went up yesterday a momentum stock. So what we're gonna do here is break down our look-back periods into 4, and then we're gonna analyze some papers that might give us some ideas as to what potentially the best look-back period might be. First, let's look at the weekly look-back period. In a study by Bruce Lehmann titled Fats, Martingales, and Market Efficiency, the author runs an experiment to test market efficiency by looking at the predictability of stock returns week over week using crisp data. The idea here is that if the market shows a potentially arbitrable strategy, then that would point to market inefficiency. For our purposes, let's just look at the results of the study. Portfolios of securities that had positive returns in 1 week typically had negative returns in the next week, while those with negative returns in 1 week typically had positive returns in the next week. That is a pretty astonishing finding. Week to week, there seems to be a strong reversal in stock performance, which means that if you're trying to run a momentum strategy, going week to week might not be a good idea because there tends to be mean reversion and not momentum over the short term, according to the study. So if not week to week, what about month to month? In the paper titled Evidence of Predictable Behavior of Security Returns, the author finds that stocks tend to exhibit negative serial correlation month over month. This means that stocks that had negative performance in 1 month tend to show positive performance in the following month. On the other hand, stocks that had positive performance in 1 month tend to have negative performance in the next month. Additionally, he reveals that there seems to be reliable evidence that the serial correlation in stock returns is a general phenomenon observed over a fairly long period and also across the entire cross-section of stocks. The reason this is important to note is because if there is predictability in the stock market, one can potentially exploit this behavior in the search of potentially higher returns. It also hints at the idea that there are potential behavioral distortions that make the market either less efficient or at least prone to human error. So we've seen some evidence to suggest that over the short term, momentum doesn't work. Week over week, month over month, generally a bad idea to run a momentum strategy. But what about the long term? In the paper titled, Does the Stock Market Overreact?, the authors find that over the last half century, loser portfolios of 35 stocks outperformed the market by, on average, 19.6%, 36 months after the portfolio formation. Winner portfolios, on the other hand, earn about 5% less than the market, meaning that over the long term, in this case at least 3 years, there seems to be mean reversion. Winners become losers and losers become winners. So what? Does momentum just not exist? I've got one more paper. And of course, we couldn't go through a whole video talking about momentum without mentioning this seminal paper titled Returns to Buying Winners and Selling Losers, Implications for Stock Market Efficiency, where the authors find that strategies which buy stocks that have performed well in the past and sell stocks that have performed poorly in the past generate significant positive returns over 3 to 12 month holding periods. As you can see, intermediate term momentum, defined as buying stocks that have done well over the past 3 to 12 months, produces above market returns, at least according to these findings. One more quote that I found fascinating. It is possible that the market underreacts to information about the short-term prospects of firms, but overreacts to information about their long-term prospects. As you can see, it is paramount to note that momentum needs to be a highly dynamic strategy. Momentum stocks are momentum stocks for a short period of time, and therefore you cannot just simply buy and hold these stocks forever. And that is what I love about momentum. Not only has it beat the market according to these findings, but it also has this dynamic component that attempts to evolve with the market. So there you have it. If you're trying to build a momentum strategy, according to these findings, you should probably target an intermediate term look-back period, whereby you buy the winners over the past 3 to 12 months and avoid the short and long-term winners. If you enjoyed this video, go ahead and like and subscribe, but more importantly, share this video with a friend. If you want more educational content, make sure to go to alphaarchitect.com/subscribe to subscribe to the blog, which has tons of educational materials. And you can also go to Instagram and TikTok at Coffee Hour with Jose, and there make sure to follow me. I'll see you next time.